Today's subject, acronyms or terms that you might not be quite aware of. Hi, I'm Jeff Banks, the founder of Banks Consultancy. I have with me Carol Mitchell from Banks Consultancy, Not Your Ordinary Accountants, and these are our tidbits of the day. And like a normal Tuesday, we're going to go through some acronyms or some terms that you might not fully understand. Carol, line of credit. What do you take out of that?
That you have a credit facility that you're available to draw down on if you are short of funds or need money for certain things within your business.
All right, from a tax point of view, using a line of credit where you mix deductible costs with non-deductible costs can create a nightmare for the claiming of interest. What we would suggest, if you're going to put money into your mortgage, rather than use a line of credit, would be rather to use an interest offset account. Now what that does is it sets up a separate bank account that you put your money into, and you pay only the interest on the difference between what your offset account is versus your mortgage. So if your mortgage is $100,000 and you have $30,000 in your offset account, then you only pay interest on $70,000, right? So it works well for you. If you've got this as an investment property, then you maintain your tax deduction here, but if you were to pull out some money out of here to go and buy a boat, you haven't jeopardised the deduction of your interest. All the while, making sure if you've got plenty of spare money in here and you're playing the 55-day game with your credit card,
Yes.
the movement up and down of a line of credit will create you all sorts of problems from a tax point of view on the claiming of interest, whereas here we preserve the amount of interest that we're claiming, or we are, by using all our money into an offset account, you generally will find that the interest rate across both of these is less than your line of credit, and that you will save more money by dumping everything into your offset account. Now, interest offset accounts are a very good way to pay off your mortgage much quicker than you should.
Yes,
Right? If you've got a loan that you're paying off at 25 years at 25 years worth of monthly payments, it takes 25 years to pay it off. If you're using your offset account, dumping every spare cent into your offset account, and then using your credit card and using what would normally be the normal 55-day sweep, where I don't pay any interest on my credit card, you can effectively turn a 25-year loan into 8 years. I have the spreadsheet to prove it. All right, so they're the sorts of things that we talk to clients about from a cash flow point of view, from a not building wealth, because we're not financial planners, are we?
No, we're not.
But just the simple things that can be done to make your wealth grow much faster than it should. I'm Jeff Banks. This is Carol Mitchell. We are from Banks Consultancy, and we are Not Your Ordinary Accountants.